This chart shows Bitcoin's price action through late August 2026. After months of flatlining between $60,000 and $64,000, the price violently surged, peaking near $79,800. Staring at this vertical spike triggers an immediate visceral reaction, the overwhelming urge to buy in right at the top. But to make a rational decision here, we have to separate genuine, sustainable investor demand from forced mechanical market buying. The headlines are pointing to institutional adoption and regulatory shifts, like the U.S. Clarity Act, to explain the move. The underlying mechanics of this price action, however, are highly deceptive. We are going to deconstruct the traditional finance catalysts that sparked this rally and the crypto-native leverage engines that actually drove the price. Understanding the difference between a broad macro catalyst and a short-lived mechanical accelerant is the only way to make a solid, data-driven entry decision and keep yourself from buying into a trap. The initial spark for this rally came from a dry U.S. Treasury press release regarding government bond buybacks. The Treasury announced they would double their long-term bond buybacks from $2 billion to $4 billion. This specific policy move had an immediate mathematical effect on 30-year Treasury yields, dragging them down from multi-year highs of 5.33% to 5.18%. When risk-free government bonds pay less, capital abandons them. That money starts hunting for higher returns elsewhere, turning toward volatile assets like Bitcoin. There is, however, an opposing macro force that could abruptly choke off this liquidity tailwind: the Federal Reserve's new leadership. Newly sworn-in Federal Reserve Chair Kevin Warsh has explicitly stated his goal is regime change at the central bank. His specific policy mandates include shrinking the Fed's bloated balance sheet and instituting strict, binding policy rules to aggressively control inflation. Entering the market solely based on this Treasury liquidity injection ties your portfolio directly to government fiscal policy. If the new Fed chair successfully tightens the money supply, you are left highly vulnerable. While the macro environment moves slowly, the majority of this rally actually took place in the violent reality of the crypto derivatives market. Prior to the Treasury announcement, trader positioning was heavily skewed toward bearish short bets. When the price suddenly ticks up, a short squeeze triggers. Exchanges automatically close out losing short traders by market buying Bitcoin on their behalf, which forces the price even higher in a self-reinforcing loop. The scale of this specific squeeze was massive. $3 billion in short positions were liquidated, with over $1 billion wiped out in a single hour. This chart compares the buying pressure. Moderate organic demand in U.S. spot ETFs, roughly $500 million in inflows, is set against a towering $3 billion spike of forced liquidations. Over 90% of this price violence was simply leverage unwinding, not fresh capital. Short covering is a finite fuel source. Once those leveraged traders are flushed out, the forced buying stops entirely. Buyers who enter at the top are left completely exposed to a severe momentum stall. Looking at the immediate technical aftermath of this historic short squeeze reveals exactly how extended the market has become. We use the Daily Relative Strength Index, or RSI, to measure whether an asset's momentum is organic or dangerously overextended. During the test of 80,000, Bitcoin's daily RSI peaked over 92, officially classifying the asset as severely overheated and euphoric. Historically, RSI levels in the 90s almost universally precede sharp pullbacks or periods of exhaustion. Before the squeeze launched, the market established a critical structural support floor in the $70,000 to $72,000 demand zone. Executing a buy order right now means sacrificing a mathematically safe entry at that $70,000 support floor, merely for psychological comfort. That trade drastically skews the risk-to-reward ratio against you. The August rally was powered by a dual engine, a valid structural macro foundation that was artificially accelerated by a temporary leverage squeeze. This flowchart breaks down exactly how to navigate your next move, depending on your specific financial goals. If your profile is a long-term hold, your first step is to completely ignore the FOMO generated by the headline price. This breakout is a net positive macro signal for long-term investors, but you must let the leverage flush out. Wait for an inevitable retest of the $70,000 to $72,000 support zone before deploying your capital. If you are looking for a short-term trade, buying resistance near $80,000 is extremely dangerous. Momentum traders have to closely monitor ETF inflows. If organic volume drops off as the short liquidations end, a rapid correction back to $67,000 is highly probable. The trade-offs in this market are absolute. You can choose to pay a dangerous premium for momentum, or you can exercise patience and wait for structural support. Choose the reality that matches your timeline.